Imagine this. You're in your early 30s, maybe even pushing 40, and you're dreaming of owning your first home. But here's the catch. What you see on the market is completely out of reach. The median age of a first-time homebuyer is now creeping toward 40. That's right, 40. People who once expected to buy a home in their mid-20s are now waiting decades longer if they ever get there at all. It's not just age that's shifting. The very structure of homeownership is changing. 1% down mortgages are popping up more often. 40-year loans, loans that stretch your financial life further than ever, are becoming increasingly common. On paper, they make houses affordable. But here's the thing. Stretching a loan out over 40 years doesn't make it cheaper. It just makes you pay more in interest over time, and it locks people into financial strain for nearly half a lifetime. The numbers tell a story that is, frankly, hard to digest. The median family now has to spend almost 40% of its income just to cover the mortgage payment on a median-priced home, and that's before factoring in income taxes, insurance, maintenance, and property fees. In some high-demand cities, this number skyrockets past 90%. Let that sink in. 90% of a family's income going toward housing. Essentially, the average family cannot afford the average home, and it gets worse. For most buyers, especially first-timers, buying a house isn't about saving diligently for years. It's about timing a sale perfectly. The majority of people who can buy a home today are those who just sold another one. That's why first-time buyers now make up the smallest share of the market in over 4 decades. The ladder to homeownership is breaking, and the rungs are slipping further apart. Now, you might think, okay, so it's bad now, but surely it can't get much worse, right? Well, that's the part where reality bites. Despite these already staggering figures, a combination of economic forces, policy trends, and market pressures is lining up to push affordability into territory most people never thought possible. Rising mortgage rates are just the tip of the iceberg. Household debt is ballooning. Inflation is relentless. And let's not forget an aging population with shrinking incomes relative to housing costs. On top of that, speculative buyers and institutional investors are crowding the market, often paying cash for homes that regular families can't even dream of. So here's the question we need to ask ourselves. What happens when all these factors collide? How much worse can home prices really get? And more importantly, what does that mean for families trying to find a place to call home? In this video, we're going to break it all down. We'll look at the numbers, explore the trends, and connect the dots to show just how fragile the dream of homeownership has become. By the end, you'll understand not just the what, but the why behind the market's volatility, and why this isn't just a story about housing. It's a story about the economy, wealth distribution, and the very way people live, because make no mistake, the worst may not be behind us. In fact, it might just be getting started. Let's start with the obvious culprit, mortgage rates. Over the past few years, rates have surged from historic lows to levels we haven't seen in over a decade. At first glance, it seems simple. Higher rates mean higher monthly payments, and that should cool demand, right? But the reality is more complicated. Higher rates don't just affect monthly payments, they ripple through the entire housing market. Sellers start pricing homes based on what buyers can afford, which pushes prices down in some regions. But in high-demand cities, it doesn't work that way. There, buyers are so desperate to get in that they stretch budgets to the limit, often taking on decades-long loans or accepting risky financing terms. This creates what economists call a payment shock. People are paying far more than they should, but they're still willing to pay it. And it's not just rates. Household debt is soaring. Credit card balances, student loans, auto loans. These aren't minor burdens. For the average family, debt now consumes more of their disposable income than it did 10 or 20 years ago. That means less flexibility, less ability to save, and more risk if something goes wrong, like a job loss or an unexpected medical bill. Imagine trying to buy a home when 50% of your income is already committed elsewhere. It's a recipe for disaster. Then there's inflation, the silent thief. Everything costs more: food, utilities, transportation. even if your salary rises, it often doesn't keep pace with inflation, leaving less money for housing. Yet, the market keeps moving upward. Builders face higher material costs, which they pass on to buyers. Cities with limited land supply see prices climb simply because demand outpaces the available inventory. Speaking of inventory, that's another major factor. Across the country, housing supply is incredibly tight. New construction hasn't kept up with population growth for years. Meanwhile, investors and large institutional buyers are scooping up single-family homes, converting them into rentals, and effectively taking them off the market for buyers who want to live in them. First-time buyers are losing out, and those who manage to purchase are paying premiums that were unimaginable a generation ago. And here's a twist most people overlook: demographic shifts. The younger generation, millennials and Gen Z, is larger than any generation before, but they're entering the market later and with less wealth. Many are burdened by student loans, unstable jobs, or high rent costs. This delay in home buying pushes up prices for everyone else because demand remains high, but supply is fixed. Finally, consider government policies. Tax incentives, zoning laws, and mortgage programs can all have unintended consequences. Programs meant to help buyers can sometimes inflate prices by artificially boosting demand. At the same time, restrictive zoning keeps supply low, which drives costs even higher. It's a paradox. Well-meaning policies that are supposed to help can actually make affordability worse. When you put all of these forces together, high rates, soaring debt, inflation, limited supply, investor activity, delayed home buying, and policy quirks, you begin to see a market teetering on the edge. It's like a Jenga tower stacked with invisible financial pressures. Each new factor increases the risk that a small shift could trigger a significant collapse, or at least make prices even less attainable for the average buyer. So, if you thought housing was bad before, brace yourself. The next wave isn't coming. It's already here. And it's not just about higher prices. It's about who can afford to buy, who's locked out, and what happens when an entire generation finds that the American dream of homeownership is slipping further away. So, what happens if home prices continue their upward march, or worse, start to spiral uncontrollably? The first casualty is affordability. Families are already spending a massive chunk of their income on housing. If prices rise further, owning a home becomes an exclusive privilege, not a milestone for the average family. First-time buyers could be shut out entirely, creating a permanent divide between homeowners and renters. Certain cities are especially vulnerable. High-demand markets like San Francisco, New York, and Los Angeles are already operating in a realm where median incomes can't touch median home prices. In these cities, home ownership is becoming almost impossible without extraordinary luck, family wealth, or extreme financial risk. Secondary cities aren't immune either. Rapid migration, supply constraints, and investor activity can make affordable markets vanish faster than anyone predicts. But what about the broader economy? Housing isn't just a place to live. It's the backbone of wealth for millions. When home prices climb faster than incomes, the middle class shrinks, consumer spending tightens, and debt levels rise. We could be looking at a slow-moving financial squeeze that's far more insidious than a sudden crash. It's a simmering crisis, not just for buyers, but for the stability of the economy itself. And here's the kicker: history shows us this isn't unprecedented. The 2008 housing crisis started with similar pressures: high leverage, risky lending, and overvalued markets. The difference today is that some of those risk factors are amplified. People are older when they buy, loans are longer, and debt burdens are heavier. When the bubble eventually corrects, or if rates continue to climb, the consequences could be devastating for families who thought they were finally getting a foothold. So, what can buyers do? For those still hoping to enter the market, knowledge is power. Understanding your budget, avoiding over-leveraging, and being realistic about location and timing can make the difference between a sustainable investment and a financial trap. For investors, the opportunities are nuanced. Certain markets may overheat while others remain undervalued. The key is patience, data, and a willingness to adapt. Ultimately, the question, how much worse can home prices get, doesn't have a simple answer. It depends on interest rates, government policy, debt levels, inflation, and human behavior. But one thing is clear: the dream of homeownership is under pressure like never before, and the era of easy affordability is likely over. If there's one takeaway from all this, it's that awareness is crucial. The housing market may seem unstoppable, but every market eventually reaches a tipping point. Understanding the dynamics now gives you a chance to prepare, to protect your wealth, and to make smarter decisions when the tides shift. So, what do you think? Are we heading toward a slow squeeze or a sharp correction? I want to hear your thoughts. Comment below with your predictions. If you found this breakdown insightful, hit the like button. It helps others find this video. And don't forget to subscribe and turn on notifications because we're diving deeper into these economic shifts and what they mean for your finances. The housing market may feel like an unstoppable juggernaut, but understanding it gives you the power to navigate the storm, make informed choices, and maybe even find opportunity where others see only crisis. Stay informed, stay strategic, and never underestimate the power of knowledge.